You are live.
Good morning. This is a meeting of the City of Annapolis Police and Fire Retirement Commission. We will proceed with our public session meeting, and pursuant to the provisions of applicable law, we will break into executive session to discuss the management of the financial end of our responsibilities. We have a quorum present, and with that, the first order of business on our agenda, I will take the privilege of being the chair to maybe modify our agenda just a bit. The first item is going to be approval of the minutes of our last meeting. Those were circulated prior to this meeting. Hopefully everyone had a chance to read it. With that, could I have a motion to accept or amend the minutes? And we're talking now of the minutes of the public session.
So moved.
Second.
Second.
Those in favor?
Aye.
Anyone opposed? With no opposition, those minutes are adopted. We will then move to a review of the general state of our investment economy, and with that, I'll turn it to Mr. Jones to give us a presentation.
All right. Thanks, Joe. And good morning again to everyone. So I just shared my screen, and I trust that the email I sent out was received. That had the materials that I'm going to be reviewing today. So first of all, we have a snapshot of the agenda, and I'm going to begin with a review of the investment markets as of December 31st, 2022. And 2022 was challenging because we had a correlation in returns between equities and fixed income, both double-digit losses experienced in the equity and fixed income market. So when you look at whether it's year to date or the 1 year, they're the same numbers. But we had losses of negative 18 to 20% in US domestic equities. The S&P 500 was down about 18. The Russell 2000, which is representative of smaller companies, was down roughly 20%. 2022 is characterized by a year where the growth part of the market, the companies which had done well for the prior decade relative to value, the growth companies gave up most in 2022, and they had more to give up because they did exceedingly well through 2021. And I'll share with you a little bit more detail on some of those growth names that we're all familiar with in the following page. The value market, as is characteristic in a down market, protected more on the downside. And you can see the Russell 1000 Value Index was down about 7.5%. And international stocks in the developed world, which is the MSCI EAFE index, Europe, Australia, and Far East, was down about 14.5%. So a little bit better, losing less than the US markets, and the emerging markets were down about 20. But the challenge in 2022, as I mentioned, was the double-digit losses that we experienced in the fixed income market. And you can see the US aggregate index, representative of high quality investment grade bonds, was down 13. Investment grade corporates were down about 15.75%. High yield bonds, which are the riskier, lower quality part of the bond market, protected more because they entered the period with a higher yield, and they had less of an increase in their yield, so they had less in market value losses. The more expensive part of the market were high quality AAA Treasury securities, which ended the period with virtually no yield, and they had a very significant backup in yield that resulted in those market value losses. And then global bonds were down about 16.25%. So what I also included, though, was an update of the markets through February 6th. And so if we look at the year-to-date column, we see where the markets were for the first roughly 37 days of 2023. And we've gotten off to a good start. On the equity side, we are in positive territory. You can see returns. Large cap equities were up better than 7%. And you had better than 10% returns coming from medium and small companies. You've actually seen a little bit of a rotation where the growth names are leading in 2023, up 10.5%, where value is up 5%. And we have decent mid-single digit returns coming from both developed international and the emerging markets, as detailed. The bond market has had positive returns. We've had generally a falling interest rate environment, and rates have fallen because the government has reported that the Fed's actions in trying to ward off some inflationary pressures has had a impact, and we've seen more favorable inflationary numbers, and that has allowed the fixed income yield environment to fall. And you see a positive return of about 2.3% from investment grade bonds. High yield bonds were up 4.25%, and global bonds were up about 2.35%. I mentioned the growth part of the market, and the challenging part over the last couple of years, or the last year, has been these growth names, but they have rebounded in some case the most in 2023. Down at the bottom, you can see the FANG stocks. Facebook year to date is up 54, Amazon is up 21, Netflix is up 22. So these are some of the names that disappointed the most in 2022, but have rebounded the most in 2023. Something that I think I've pointed out at prior meetings is where we have come over the last 2+ years relative to where we were just prior to COVID. And so I like to show this particular column in the upper right-hand part of the page. The equity market was at an all-time high in February of 2020, February 19th of 2020. And interesting to note that relative to being at that all-time high, today, or as of yesterday, actually this is as of 2 days ago, the equity market cumulatively is even higher than where we were pre-COVID. You can see the S&P 500, just as an example, cumulatively is up 27.3% higher than where we were on February 19th. The bond market over that same period, if you go down below, is negative. So investment grade bonds relative to where they were on February 19th of 2020 are down 7.6% cumulatively. So if an investor said, I want to become more conservative and get out of the equity market and go into a perceived safer investment in fixed income, the bond investor would have actually lost 7.6% versus the equity investor who has had a cumulative return north of 20% in both US large, mid, and small cap equities. So, the reality is that we had a tremendous run in the equity market from the market low on March 23rd until the end of 2021. The market was up over 120%. And we have given some of that back. but I would say we probably had to give some of that back because the markets went up sort of unrealistically so over that time period. I'm gonna pause for a minute to see if there's any questions. Okay, so I put a couple extra charts in here, which I'll just touch on. As I mentioned, the government has been very aggressive, the Federal Reserve, in trying to ward off the inflationary pressures. And this shows Fed interest rate increases over the last 40 or 33 years, from 1990 through 2022. And you can see over on the left-hand side, we've had 8 interest rate hikes over the past 11 months, totaling about 4.5%. And relative to history, this is the quickest and most significant rise in short-term interest rates that we have seen in most recent modern times. That has resulted in a very significant rise in yields over the Treasury yield curve. Here we show the Treasury yield curve at the end of December of 2021, and then the yield curve at the end of December 2022. And the little numbers in black, in the black boxes, show the magnitude of the increase over this period of time. So you look at the 6-month Treasury bill, and you went from a yield close to zero to a yield as of December 31st, 2022 of 4.75%, for an increase of 4.57%. And we have something called an inverted yield curve today, where you get a higher yield for short and intermediate term securities relative to the long end of the yield curve. And so typically in this type of environment, eventually we will likely see some sort of recessionary environment from an economic standpoint. And the question is, not if, but I think more so when and how long and how deep such a recession might last. But that is if you go based upon history, in prior periods where we've had inverted yield curves, it has pretty much always resulted in some form of a recessionary environment from an economic standpoint. And when you characterize the corollary negative returns coming from the equity and fixed income market, we've charted on this slide going back to 1976. Each dot represents the equity and fixed income market returns over that period of time from 1976, the individual calendar years. And you can see the outlier is in the lower left-hand corner for 2022. The equity market represented by the S&P 500 had a return of about negative 18%, and the bond market was down 13%. Typically, when you have a negative equity return, you typically have a positive bond market, because usually the government, in a environment where equities are negative, it's typically as a result of a weaker economic environment. And in that environment, the government tries to stimulate the economy by lowering interest rates. But in 2022, we had the inverse of that. The government was trying to ward off the inflationary pressures, slow the economy down by raising rates, and that caused this negative return environment on both sides of equities and bonds. So then if we go on and look at prior periods, we look at prior periods where we have had losses of greater than 20%. And you go back to the dot-com bubble, or what is referred to here as the tech wreck, back in 2000, 2001, 2002. We have the global financial crisis in 2007 through 2009. We have the pullback as a result of the coronavirus impact, relatively short period of time, 23 trading days, and we lost 34%. And then we have the period that we've experienced in 2022, where we've had inflation and interest rate impacts. And what we do up top is we look at, after these periods of drawdown, how the equity market has performed in subsequent periods following these significant drawdowns. And we don't yet, you can see after coronavirus, 1 year later, the equity market was 77.8% higher. So the question is, after our most recent drawdown, where do we go 1, 3, 5, and longer periods after this drawdown period? And hopefully we will follow suit with history, and we have brighter days ahead. We do the same thing looking at the bond market, and when we've had periods of time where the bond market has had a loss of 5% or greater, and you look back in March of 1980, September of 81, June of 94, and the most recent period is October of 2022, where the losses exceed all the other periods going back to 1976. But the same thing, if you look at 1 through 5 years after these drawdown periods, very positive returns. So when I mentioned that, if we come into a recessionary environment, weaker economic environment, what's the next thing the government will do, the Fed will do, is that they'll lower interest rates to try to stimulate the economy. And that will result in more positive returns coming from the bond market if they were to lower rates, as has happened in the past. So to put into perspective sort of the run-up that we just had a phenomenal run after the global financial crisis. The bottom of the GFC was in March of 2009. And we basically went up about 18% per year from March of 2009 until the end of 2020 of 2019. Then we had the coronavirus pullback. Then we had the 120% run up through 12/31/2021. And then we've had this pullback right here. We are starting to bounce back a little bit, but we do have more to go to recover the losses in 2022. Very difficult to pick the periods where we trade down. And I have another chart in here which will look at market timing. This simply looks at bull and bear markets back to 1945. And a bear market is a period where we lose greater than 20%. Bull market is a period where we gain more than 20%. There's been 14 bull and 14 bear markets over this entire time period. This is the S&P 500 index, and over the entire time period, the index has returned more than 11%. So to get that 11% return, you sort of have to be invested for the entire time period. But the takeaway here is that the green outweighs the red. The red is difficult, but the red typically is followed by a period of market gains, which allow you to benefit from that longer term 11% type return. And going back to 1926, the S&P's returned a little more than 10%. So again, you would see a similar sort of chart going back to 95 plus years. And this looks at the S&P 500 back to 2007. And this is the chart which shows how significant an impact a small number of days have on both the downside and the upside of the equity market. And so that over the entire time period, if you were invested for all 3,854 trading days, you would have earned 8.62%. It's interesting that if you missed the best 5 days over those 3,800 days, if you miss the best 5 days, your return goes down to 5.42. If you miss the best 10 days, your return goes down to 3.2. The best 15, your return goes down to 1.4. And if you miss the best 20, you actually have a negative return. Now, conversely, if you miss the worst days, your return goes up considerably. The point here is that it's really, really hard to pick these best 5 and worst 5 days and so on and so forth. So it sort of speaks to the importance of being fully invested and basically staying in for the long term. And we have the same detail. I'm not going to go over it on going back over a longer period of time. And another page I like to show is, questions are often asked about stock returns in an inflationary environment. And, we've had a bad run in 2022 with high inflation. But a reasonable question is like, how is the market done when you've had inflation of greater than 6% in other periods of time? And so we go back and we look at calendar years at the bottom and years in which inflation in those individual calendar years was greater than 6%. And the green bar up at the top is the return for equities, the S&P 500. The blue is the return for bonds. And it basically shows that while there are periods of negative returns for both equities and bonds in inflationary environments, there's also many periods where the returns are positive and significantly positive in inflationary environments. So when you think of it, during an inflationary environment, often you have a positive economic environment. That is partly the reason for the inflation. And so with that positive economic environment, you often have companies releasing good earnings, making a lot of money, and that translates into these potential positive returns, even when inflation is higher. So inflation doesn't always translate into negative returns coming from the equity market or the bond market. And then simply for your own review, we've got a lot more detail on inflation and the components of inflation. We break inflation down by the different goods and services. And there's a lot of variety in where inflation comes from. And I will leave that for your own review after the meeting. Joe, I think that's pretty much it for my comments on the market environment.
Thank you. With that, I would ask for a motion to move into executive session so we can discuss how our managers are doing in this environment and receive reports about their performance. Do I have that motion?
So moved.
Second. Anyone opposed? Those in favor? Aye.
Aye.
And with that, we will now